Hi guys, I wanted to talk to you about dividend investing today and what is my take on it. So, what is a dividend? Dividend is a payment made by corporation to shareholders, usually a distribution of profits. You all know by now what is a dividend. I am just giving a basic definition in case if you are not knowing what it is. So, here is my take on playing dividend stocks or general dividend fund. So, what are the pros in finding a stock which pays dividend? I am really not a fan of any individual names. Okay. The reason why I'm saying that is because I don't think I have seen a potential dividend winner or the long term. What does that mean? I'm not saying the company which pays dividend will not be existing after 10 years or something like that. That's not what I'm saying. Over the long term, when you see, right, the growth is so limited. It's like after being invested in for a long term, let's say you invested in Macy's when it was like 44, not even at the highs. Let's say you invested it when it was around 20, 28 or $30 just for the purpose of getting a yield of 6.79%. Where is it now? Your principal is almost evaporated. I didn't see any kind of potential profits being made on this. You cannot say your yield started increasing or you got it at a good yield so you're starting to make good money on it. What happens on the long term? If you are going to be on a dividend stock, I'm sure you guys are going to hold it for a long term just for getting the dividend probably every quarter or monthly. It depends on the company. And there is always a possibility with the individual name. Always there will be a possibility the dividends can be cut. In such cases, dividends can be cut. I'll give you another example which I was personally involved years back, but I believe uh, I'm not I believe I came out of the name, on time. I just didn't hold on to it. It was one of those um, um, energy plays which was yielding very high because it was a limited partnership, and I really played it for just a day or two just to scalp and I came out. I never held on to it, but it was playing a dividend close to 12%. Many people held on to it and it went bankrupt. So you see, the problem is you really do not know where the bottom is, and just because the company is paying dividend doesn't mean it can survive for the long term. Why do you think a company is paying a dividend? A company might be paying a dividend to keep its shareholders happy and to also say to you guys, we do not have anything to invest on other than returning back the money to the shareholders. I would prefer share repurchases over dividend payment for any company. That way, we know the number of shares out there are, you know, limited or the float is getting limited. I would definitely prefer to have a company do the share repurchases over giving a dividend, because most of the time what happens is I believe once the dividend is paid, like after a certain number of years, not all the people will be the same shareholders again down the line, because they might be picking out and going into some other names for some other reasons. It could be even a large mutual fund or um, a great dividend fund holder for growth and income investors. So that is the reason why I say there is no, I'm really not finding any kind of pros. Even some of the financial websites would mention it that it is having pros, but I'm really saying I don't see any kind of pros in these individual names. But on the other hand, you might want to consider a dividend aristocrat index, which I think will is a better play, like what I'm saying, and there is less worry because it's diversified enough. Like this could be an example, could be Noble. Okay, Noble is a dividend aristocrat index. Okay, it holds almost maybe I believe top 50 or so, and these are some of the names that it holds. So if you see over the years, it's yielding 1.91%, but that's not the point here. The point here is all the individual names, the dividends that are inside this fund, I believe they reinvest the amount inside, and that's how this index generally works. This, especially this index which I'm pointing to you. And overall, I think this is a safer bet than going and playing a individual name like which you cannot predict. Okay, look at what has Coles done recently. It's going down, and there could be a possibility this company might be bankrupt, or it could reduce the size or increase the shares that's being diluted out there for for better growth and to close down its debt, or also at the same time maybe cut down the dividend also. So what are you going to end up being? A loser? So it's better not to go into an individual name if you are really wanting to play in the sake for the sake of getting some dividends. Go with the better ones like Noble. To show you in a better way, like what do I mean by this when I say not to hold on to it, just go to cnnmoney.com and just type in any names that you want. Let's take a look at, for example, let's take a look at an example of Macy's itself, the one which we were just looking at. And let's see what has it done over the past 5 days. Already 2.88% down. What is the dividend that Macy's is currently paying? Let's take a look. Somewhere around 6.79. Okay. Is this a good investment? When you look over the last 5 days, it's negative 2.88%. Don't go and do bottom fishing here. Think about it. 1 month, negative 3.97%. 3 months, negative 20.94%. Year to date, 37%. 5 years, negative 34%, and you're getting some dividend like 6%, like which happened to be the case because the shares were so low priced as compared to the when it was around 60 and above. Why would you invest in a names like this? And it's almost hitting the 52-week low. You have gained nothing. So my advice is not to go onto an individual name. I would be more safe owning a large or a better in fund, a dividend fund, you know which might have distributed its assets overall. Like, let's take a look at this one. What did it do for the last 5 days? Negative 1.2. That's fine. That is usual. Year to date, it's 7.53% year to date, right? Let's look at it in a better way. Year to date, closer to 6% or 7%, sorry. 1 month 0.75. Let's see an average for, because this was newly introduced, I believe it was started in maybe 2014 or so. So that's why we do not have a track record for the last 5 years what it did. But let's see, the last 3 years it gave you an average of 10%, right? That's still better, right? It's still better than owning Macy's. So I still think that it's better to hold on to the dividend players, dividend index players, rather than investing on an individual name which you think is better because of its high dividend that it's paying. Do not do that. Or any stock that is inside a dividend aristocrat like AT&T. Since it's at the lowest point, probably you will say, and it's yielding like something like close to 6%, you might say, oh, it's a good pick. But always make sure, right, like on the overall, how is it done so far? So it's better, sometimes it's really better that, you just don't fall for it. Like, thinking, look at it, year to date, negative 10%. Now let's see what it has done like over the last 3 years. If you had invested on it, what is your return? Negative 10% year to date. Thinking why didn't it? Okay, 3 year change, 5.89% with an additional dividend of another 5% maybe. It's really not a good return. Maybe 3 years it is okay. For the last 5 years, 7%. I wouldn't really recommend this to begin with. You are not really in a safe bet or a safe zone. You do not know what's happening. There could be a lot of reasons as to why this is happening. So maybe you might want to consider a dividend index fund like dividend aristocrat noble, and play this because this one at least you can sleep well overall compared to the regular dividend stock. On the other hand, if you are more wanting to diversify, I would still recommend you to go ahead, buy the Vanguard Total Stock Market Fund. This is a better way to play. Less risk. This also pays you a dividend of close to, I believe, 1.98% or so, but it's less risky. And even though dividend funds might be able to, top this fund by fraction of maybe 1% or maybe 0.8%, dividend, it doesn't guarantee you that, the general mark, it can always be the general market. So I would suggest to go in an alternate option like VTI, and stick with the fund, and do not you don't need to purchase everything in one shot. You can diversify and put little by little money into this fund on a monthly basis. This is something which I'm trying to do actually. Year to date, I mean, from the starting till date, I haven't been able to do this because I am still a short-term believer and not a long-term believer. Even though my averages are like closer to 13%, 13 to 15%, and it can vary up to maybe 30% in some years. But I'm not trying to say that I'm always going to be able to beat the index. There might be cases where, when it's like in the year 2008, I'm I'm pretty sure like if the market is maybe down for that particular month, closer to 8%, 8 to 10%, maybe my investment thesis would be wrong or might be 20% down for that year. But overall, in an uptrend market, generally, based on my analysis and my work, I believe I can easily achieve above another 6 to 10% above the current market price if it's still in the bull trend. That's because I'm playing in the top sectors within the market and picking the right names as per the trend. And also, I'm not always a long-term guy and I do not play stocks all the time buying. I do short stocks. And that's something which I'm actively trying to get in. So how do you play short-term stocks or short stocks? You do the opposite of what you do when you buy a stock long term, like based on the trend. I'd follow the trend. If the trend is towards the downside and if it's below the moving averages that I'm looking out for, maybe I'll take a shot at it and do shorting. So that's it, guys. Like, these are my basic analysis of what I think person who's thinking of investing in dividends should be thinking at the moment. So in addition to that, there were some couple of points that that I wanted to let you know. The basically the con section again when you invest in dividend paying stocks. The reason why these companies are paying like what I said again, because they don't see any kind of better investment out there, and they want to make sure they keep their shareholders happy. That's the reason why they're giving you some amount and returning it back to you. But it's hard to know how these companies will handle when the recession hits or if their sector is going bad. Like what happened to the shale plays and the shale names? Some of them went bankrupt. Um, I'm really not, having some of those names in my mind. Like you can look at shares of. There were a couple of MLPs, which those pipeline companies, which were master limited, which is having this master limited partnerships, which was paying a high dividend or like fat dividends, which many of these financial advisors were recommending people to purchase, which was like Kinder Morgan. Yes, Kinder Morgan. This was the company which I wanted to look at this. What has it been doing over the years? This yield is now 2.6. Initially, it used to pay more than this, and they cut dividend. How can anybody go in and just buy a stock like this, thinking they're going to get a monthly fat paycheck, and then later on realize their dividends are cut and the stock is performing very badly? Think about it. So it doesn't make any sense based on somebody like based on anybody's advice or any financial people who promote these kind of products to you, that you should go and just directly jump into it. It doesn't make sense. Look at this stock, how good it has been. This is the most or the worst investment I have ever seen. And I personally feel bad because I have also taken I've scalped actually. I haven't, played it a lot, but been enticed into getting involved with these kind of names. So that's the reason why I'm bringing this up, like not to get involved in these names. Similarly, do not get involved in names because they pay high dividend, and like what I said earlier, these are like traps, dividend traps. So don't fall for it. Instead, if you want to be well diversified, go ahead, purchase something like a dividend aristocrat index, which has the top companies in it. You can even see its holdings within Yahoo. You can do your own research on this. Yahoo Finance is a good place to do research. You can see all the different sectors they are, how they are diversified. They are not diversified into one particular sector. You can see the top holdings. These are some of the good names, but you really do not need to plainly go in and think you're smart enough that you can purchase each of these names and then do good. It's better that you don't do that because it's hard for you to time the market or time the market in a way that you can get in get out. So it's always better that you take a position in one of these funds. And I would personally suggest this Vanguard Total Stock Market Fund, which I've been following for some time because I think overall, from so many reviews that I've seen, even though this fund gives you like over the last 10 years, the performance was 7%, 5 years. Overall, it is a stable fund, but when the market corrects, it does go down. But overall, if you are in for the long term, probably you can, put a small amount every month into this and keep purchasing it like little by little, little by little, little by little. Do not go ahead and put all your money into it. Maybe on a down day market you might want to purchase this index fund, maybe. Or else if you are not into index funds, you can trade stocks individually, but always make sure the stocks that you're purchasing are trending in a good way, in a good direction, and you are also following the general market trend. If the general market trend is not in your favor, do not waste time trading stocks. Like in 2008, it was a time to short stocks, and probably many would have thought that it's better to go long. No, the, if the trend changes, like even during 2010 flash, if the trend had changed, like here it did change, probably it's a good idea for you to step out. And if you do not know how to short, maybe you do not need to short at all. You can just step out for the time being until you see a breakout happening again. You don't need to get involved. Similarly, again in 2011, market wasn't doing good, it came down, and maybe that was the time to buy in, or maybe it was time to step out for the time being till you realized, like after a month or so, that it was able to recoup all the losses it made, and then the trend is again back intact. So you need to be careful. If the market generally is not in your favor, it's better, no matter what the growth names are, it's better that you cut it out, cut the loss if it is against you, and step in back again. You can always step into a stock back again, but if the stock is always heading towards a bottom, like it's always going to hit down, it's better not to get involved with the name because you do not know where the bottom is. The point is that you do not know where the bottom is for Macy's because you really do not know the reasons when it's going to go up. There could be a lot of possibilities for it to go up. So when is the right time to buy Macy's? Maybe there is no good time to buy Macy's because the trend is completely broken down and there is no good consolidation stating that, oh, it's the trend has reversed. There is no way you can know that from this chart. But this chart, it clearly shows the trend is still intact to the downside. Maybe you can short it, but I wouldn't even short it because you missed all the good opportunities. From here to here, this shorting itself would have made more than 50%. And I don't think it's a good idea to short a stock which is more than down 50%. Maybe it will just keep consolidating to the downside, but it'll be consolidation, not a huge candle like this you will get every day. It's not going to happen. So probably that's the better way to do it. Stay away from these names, even though they have high yields. So, and also, these companies like AT&T would have been existing for a long time. But the thesis here is like if they do not find anything to grow their business, they'll be stuck in this range for a long, long time. They'll be stuck in this range. They can either be stuck in this range and give you dividend throughout, or they can purchase some either good companies, smaller companies, and grow exponentially. So when they do that, they would have done better. See for the other way around. Look at T-Mobile, a company which has never even been paying dividend. It is again in the same sector. Look how it has performed versus AT&T. AT&T paying dividend haven't even been able to beat T-Mobile stock performance over the years. What is the reason behind it? Because T-Mobile invested their money in their own ways, and they had a separate class of shares which paid dividend. So there was more growth in T-Mobile than AT&T had. So you got involved with the wrong name, and this would have given you probably more returns than T-Mobile would have over the years. Let's look at it if that's a true statement. T-Mobile gave you an average of 7.9% over the 5 years, right? Let's see what I mean AT&T gave you 7%. Let's see what T-Mobile gave you over the last 5 years. Over the last 5 years, mm, doesn't show me exactly why. I'm not sure. Okay, here are it's broken down basically in an individual way. So year to date 10.2%. Each of these years, just look at this and average it. About 30% for sure, no doubt. This is much better return than getting involved with a name like AT&T. That's the reason why I'm telling find these good growth names or like where the trends are up, not when the trends are in the sideways action. Probably here would have been a good bet to get involved, like somewhere here, but again it dipped, so you would have got out. Maybe somewhere here you could have initiated a position and scalped it accordingly in each move. So that's the reason why I'm saying like you need to be involved in the right names within the sector if you really want to participate in that sector rather than just looking at a dividend player. So that's it folks. So I'm closing down this video before making it too long, and these are some of the points that you know I want to share with you guys. Thanks, and that's all for now. Talk to you guys.